Welcome to today's topic on self-employment taxes and what freelancers need to pay. If you work for yourself, understanding these taxes is crucial for staying compliant and avoiding surprises at tax time. Let's dive into the essentials of self-employment taxes. Self-employment tax is a special tax that covers Social Security and Medicare contributions for people who work for themselves. When you're an employee, your employer pays half of these taxes and withholds the other half from your paycheck. But when you're self-employed, you're responsible for paying both the employer and employee portions. This is the fundamental difference between traditional employment and self-employment taxation. The total self-employment tax rate is 15.3%. This breaks down into two components. 12.4% goes toward Social Security taxes, and 2.9% goes toward Medicare taxes. Together, these add up to the 15.3% rate that applies to your net self-employment income. Remember, this is in addition to your regular income tax. Several types of workers must pay self-employment tax. Sole proprietors who run their own unincorporated businesses are subject to this tax. Freelancers and independent contractors who provide services without being employees also pay it. Additionally, if you're a partner in a partnership, you're required to pay self-employment tax on your share of the partnership income. Essentially, if you earn income from working for yourself rather than as an employee, you'll likely owe self-employment tax. Calculating your self-employment tax involves a simple formula. First, take your net earnings from self-employment. Then multiply that by 92.35%. This adjustment accounts for the employer portion of the tax that would normally be deductible. Finally, multiply that result by 15.3% to get your total self-employment tax. The 92.35% multiplier is important because it ensures you're only taxed on the equivalent of what an employee would pay. Let's walk through a practical example. Suppose your net earnings from self-employment are $50,000. First, multiply $50,000 by 92.35%, which gives you $46,175. This is your taxable amount for self-employment tax purposes. Now multiply $46,175 by 15.3%. The result is $7,065. That's the total self-employment tax you would owe on $50,000 of net self-employment income. Here's some good news. You can deduct 50% of your self-employment tax when calculating your adjusted gross income. This deduction helps offset the burden of paying both the employer and employee portions of Social Security and Medicare taxes. The deduction reduces your overall taxable income, which means you'll pay less in regular income tax. This is an above-the-line deduction, meaning you can take it even if you don't itemize your deductions. There are two main ways to pay your self-employment tax. The most common method is making quarterly estimated tax payments throughout the year using Form 1040-ES. These payments are due 4 times a year and help you avoid a large tax bill when you file your annual return. Alternatively, you can pay the full amount when you file your annual tax return using Schedule SE, which calculates your self-employment tax. Most self-employed individuals choose the quarterly payment method to manage cash flow and avoid penalties for underpayment.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.